Hey gang, it's Roger Scott from Market Geeks and Wealth Press, and today I want to do a three-part video series on market internals. More importantly, I want to focus on put-to-call ratio and a couple of other little things. And this is really important. Let me explain to you why. And again, I want to break this down. I want to make these detailed videos. You see this rubber band? That's what the put-to-call to ratio is. And if you're looking for a ticker symbol, it's $CPC. And that's the total put-to-call ratio of all the calls and all the puts that are open on the stock exchange. And the way it's calculated is really simple. You take your open contracts that are puts and you divide them by the open contracts that are calls. And that's what the ratio is. It's a real simple calculation and it gets updated in real time. If you go to CBOE, Chicago Board of Options Exchange, it gets updated after the close. But some services update it in real time. I find that it's only really necessary to look at this after the close. So in this video series, I'm going to explain to you levels. I'm going to explain to you how to gauge this as a rubber band. And let me explain to you why, and I'll end this video on this note, and I'll get into the second one. Imagine for a second, okay, and I tell this to my students, and this is really cool. Imagine for a second you take a trader and you put him into a room, and this trader's never traded before, and you give him money. And you take the opposite of all of his trades. Well, what do you think is going to happen? Let's say I give him $5,000. Do you think he's going to end up keeping that money or he's going to end up losing that money? I'm sure you know the answer to that. He's going to end up losing that money. He's going to make mistakes, basic mistakes. He's going to let his losers run. He's going to add to his losers. He's going to cut his winners short because he's going to be afraid, and he's going to want to lock in the profits. He's going to do everything wrong. He's going to do everything the opposite of what a professional trader would do. And that's what the CPC, the put-to-call ratio, is. What it does is it tells us when buying is getting out of whack, that it's emotional. And it's telling us when selling is getting out of whack, when it's emotional. When markets get emotional, they tend to turn around. Why? Because when traders become emotional, they're trading based on fear and greed and not logic. And that's the same thing as what a beginner would do. So I call this indicator, the put-to-call ratio, I call it fading the beginner trader, okay? And I know it's a weird analogy, but that's what it is. So let me give you the guidelines. And again, think of a rubber band expanding and contracting. If a rubber band goes this far, it's not a big deal, right? It's random. It can go like this back and forth all day and it means nothing. And that's the thing about this CPC put-to-call ratio. Most indications don't mean anything. The only real indications occur when it's below 0.80 or above 1.15. If it's below 0.80, that means buyers are just jumping into the market. Greed is controlling emotions. No one's using any common sense. And buyers are just buying, and just raising the market higher. Conversely, when you see the put-to-call ratio at 115 or higher, that means immense selling pressure is taking place. That means sellers are just dropping stocks like hotcakes. It's fear, blood in the water, blood in the streets. Traders just want to get out. And usually, not always, but usually, those lead to turning points. And we'll get into more in the next video. Hope this helps.